In this video, I'm going to focus on something specific called Roth conversions, how it works, and the do's and don'ts when it comes to it. Hi, my name is Pascal Manigan, and you're watching the Financial Ownership Podcast. So really, the idea of using something like a Roth conversion is if you have, say, a traditional IRA or 401k where you're going to have tax liabilities in the future, which might end up being higher. So what you might want to do is use something called a Roth conversion. And basically what that's going to do, it's going to eliminate a lot of the potential tax liabilities you could have in the future by strategically rolling over and changing your traditional 401k and IRA over time to a Roth account or some sort of tax-free account. There's plenty of ways you could do that where it can limit the taxes you pay in the future. Because for those of you that know how the Roth work, I explained it in a few of my videos, but essentially it's after tax dollars that you're using to put into this Roth account. So later on, you don't get taxed at all, and you don't pay any income tax at all on your money when you take distributions from your Roth IRA or 401k, which essentially is what you want when it comes to investments, because you definitely don't want to end up paying income taxes on your investments, because that's the highest tax you could potentially pay. And that's kind of the disadvantage when it comes to traditional 401ks and IRAs, is that they change what is normally a tax preferred way of stocks getting taxed, where you get taxed at capital gains rates, which is typically less than income tax rates, and you're changing it to shelter, which is going to change your investments to a regular income tax, where you're subject to federal tax, state tax, local taxes, and all the different types of taxes that are associated with regular income tax. But with Roth IRAs and Roth conversions, what you're doing is you're eliminating all of those fears of potentially what could happen in the future. So some of you might ask, why would I ever want to convert, say, my 401k IRA to some sort of tax-free asset? If you look currently at US debt, some of the top unfunded liabilities are Social Security and Medicare. And if you think about it, the US only has two options on how they could really pay these things. They can either spend less or tax more. And it's probably going to have to be a combination of both of those things for those future unfunded liabilities to get taken care of. But at the same time, that would mean that if that would happen, if both of these things were to happen, that means what we have currently as tax rates are going to be higher in the future. And another thing to pay attention to is that we're at historically low tax rates. So it's very unlikely that in the future, in the next 10, 20, 30 years, considering these massive unfunded liabilities, that we're going to be in the same tax bracket in the futures. So it's really going to be advantageous to you to be forward thinking and actually plan for taxes ahead of time, so you can limit your tax liabilities in the future when it comes to you accessing your money. So with that being said, that's a little bit on why to use something like a Roth conversion. And one thing that people might do is they might look at some sort of online calculator. And the problem with that is a lot of these online calculators are pretty inefficient in showing you how your tax liabilities are going to plan out when you make these conversions. Because it's assuming that whatever you're doing, and whenever you're converting your Roth, your traditional IRA or 401k to a Roth assets, is assuming that you're basically going to take an entire lump sum of your money. Let's say you have $300,000 worth in your traditional 401k or your IRA or something of that sort. It's assuming that you take all that money, you liquidate it, and basically pay taxes on all of it, and then you transition it to some sort of Roth account, which really doesn't make any sense at all. So, and if you work with anyone that really knows what they're doing when it comes to financial planning strategies, they're not going to tell you to do that, because it's massive tax liabilities. Why? Because if you understand the US tax system, it's a progressive tax system. So if you make $80,000 and you say convert 300,000 of it into something like a Roth, and you basically pay taxes on all that money. Essentially, what you're doing, if you convert all of your assets at one time in 1 year, if you have 300,000 worth in your 401k IRA, is you're increasing your taxable income by a tremendous amount. If you make 80,000 and you basically taking 300,000 that you want to convert into your Roth account, you're gonna have to pay massive taxes on that. So 300,000 plus 80,000, that's 380,000 that you'd have to pay taxes on. So that would push you to the higher tax rates, which currently would be about 34, 37% that you'd be paying at the top marginal rates essentially if you took that much in income. And that's why it really doesn't really make any sense to do it like that. Where it makes more sense is to take it through increments. So rather than just taking a big large sum of what your 401k or IRA is and just converting it all at once into a Roth, which really doesn't make any sense, what would make more sense is finding out what your next up tax bracket is. So say you make $80,000 a year. If you make $80,000 a year, your next up tax bracket would be 24%. So basically you wouldn't want to take over $80,000 worth of income from your traditional 401k or IRA and transition it strategically to a Roth account. And the reason why you wouldn't want to do that is because you don't want to get over the 24% tax bracket rate that the current rates are based on 2021. You wouldn't want to take out more than $8,000 from your 401k IRA account because it's an account towards your taxable income. And that way you're gonna stay at that 24% tax bracket, and your tax bracket won't go up too much, which in excess really means that your tax liabilities are a lot less. You'd rather pay 24% on your taxes, on your top marginal rate, than say 34 or 37% by taking out all of that money that you have in your traditional 401k or IRA, which is really inefficient way to do it and pay tax on all that money. There's much better ways to do that, and what you want to do is strategically take some of that money over time, making sure you're not taking too much at once so your taxable income isn't that high. And you're only paying the marginal taxes on the money that you have to. You're not paying higher marginal tax rates than you have to, because the way it works is based on your income, the higher taxes you pay. And you don't want to take too much in terms of taxable income at once, obviously, because that's just going to increase your tax liabilities, and that's just an inefficient way to do it. And if you don't have a traditional 401k or IRA, you should probably start off with using some sort of tax-free asset or some type of tax-free shelter, like a Roth account, where you're not going to pay taxes later on, considering the things like the massive tax liabilities that we have, or the massive unfunded liabilities that we have, and the low tax rates we have currently. And really, if you wanted to do some forward thinking and you wanted to really maximize your retirement income or things of that sort, there's actually ways you can use a 401k or IRA and not pay a traditional 401k or IRA and not pay any taxes on it, and potentially be in the 0% tax bracket. So what you could do potentially is get that tax deduction that you would have from a 401k and IRA, and basically use things like Roth accounts and cash value life insurance accounts in complement with those deferred accounts, which are taxable later on. With the combination of using those correctly and using those strategically, you actually could pay zero taxes on your money when you retire. And I'm not going to go over too much of that in this video, but that's something that I will definitely discuss later on how, in a detailed way, on how you could do that and pay no taxes even on your traditional 401k IRA. But in this video, I just wanted to go over how Roth conversions worked and a little bit on that. If you found some value in this video, go ahead, like, comment, subscribe. I post financial content every single week, so feel free to subscribe to the channel, leave a comment below, and until then, see you next time. Thank you.